But there's a number of things going on around NVIDIA that are really helping to power the stock. And let's just start off with the big one, and that's the continued investment from hyperscalers in their data centers. So we've heard more about things like the Project Stargate from OpenAI, as well as Oracle. NVIDIA is a big part of that. Microsoft continues to purchase these GPUs. Google, Amazon, Meta, XAI, they're all gearing up and buying these and continuing to do so. And that's despite the fact that we were talking earlier in the year about the tariffs potentially having an impact on the build out. Maybe they will, maybe they won't change their path, but they seem to just be continuing to move forward and spending. One of the other things that's worth pointing out is sovereign AI. That's something that Project Stargate in Saudi Arabia is part of. When you look at how NVIDIA was received at GTC Paris, a lot of talk about sovereign AI and getting Europe's AI up to a caliber similar to what you can see around the US and China. So a lot of countries are leaning further into the idea of having their own sovereign AI, not necessarily relying on the AI capabilities of other countries. There's also the broader push towards powering inferencing. At first, when the big kind of generative AI boom kicked off with ChatGPT, it was all about training. And that's basically teaching these models what to do, what they'll predict next, how to write, based on millions of books, generate images, things along those lines. Now it's about inferencing. It's about taking those models and putting them to work. And so the original thinking was, well, the training uses a lot of power. You need heavy duty GPUs for that, not inferencing. The opposite's proven to be true, where you need those heavy duty GPUs to continue to power the inferencing because it provides a better answer and better response from those bots. And then the last thing is NVIDIA's continued belief in physical AI. Now, that means basically robots, and that includes self-driving cars. And so they have a large footprint there in the self-driving car space, but then also Jensen has been pushing this idea of actual robots working side by side with people in factories at first, and then down the line in the future, maybe having them in your home. That's not going to come for quite a while, but NVIDIA is well positioned here because A, they have a small computer that they can use that powers some of these robots. I've seen a number of them in person. The other is that they have the capability to train them up. So using a virtual world where they teach the robot how to kind of get around and then implement that into the actual robot in the real world. So going from virtual to real and then sorting out the bugs from there. So there's a lot of positives around NVIDIA. Obviously, since it's such a big name stock, there will continue to be ups and downs, but this is why it seems to be on that upward trajectory.
During the previous 2 calendar years, NVIDIA was a definite winner for investors. The artificial intelligence, AI behemoth, stunned investors with its rapid earnings growth during that period, soaring more than 800%. Additionally, NVIDIA appeared to be the obvious pick as they sought to participate in the AI growth story. After all, this tech company supplies the best AI chips in the world, which are essential for clients developing AI platforms. Along with the rest of the IT market, NVIDIA's stock plummeted earlier this year. This occurred as a result of investors' concerns about how U.S. import tariffs would affect consumer spending and business profits. It was thought that this may cause businesses to cut back on their expenditures, which might include less money spent on AI, which would be bad news for NVIDIA. Furthermore, NVIDIA's development potential was also hampered by U.S. restrictions on chip exports to China. As a result of these worries, NVIDIA's stock fell by almost 30% between the beginning of the year and the beginning of April. However, the stock and the market as a whole have since recovered and even advanced. While the S&P 500 and the Nasdaq have hit new all-time highs, NVIDIA has risen more than 60% from its low. This movement isn't finished, in my opinion, and NVIDIA will continue to rise in the second half. Let's investigate. To understand what might come next, let's first examine the NVIDIA story thus far. AI wasn't always associated with NVIDIA. Actually, video games were the company's primary use for graphics processing units, GPUs, at first. However, the GPU's capacity to manage numerous tasks at once led NVIDIA to develop the parallel computing platform CUDA and broaden the chip's applications to include artificial intelligence. This turned out to be a crucial decision for the business, as the chart below shows how AI has contributed to a sharp increase in sales. Crucially, NVIDIA is expanding sales profitability in addition to revenue. Gross margin numbers, which have surpassed 70% in recent quarters, demonstrate this. The only exception occurred in the most recent quarter, when a penalty related to export controls caused the gross margin to drop to 60%. The charge was billions of dollars since U.S. limitations prevented planned sales. However, even without the charge, the gross margin exceeded 70%. Let's now examine the reasons why NVIDIA's stock may rise in the upcoming months. One significant aspect is that, compared to just a few months ago, the company is now fairly priced at 36 times forward earnings forecasts, down from more than 50 times. Because of this, investors may buy up NVIDIA stock because it has a lot of room to grow. Additionally, news about commerce in general may spur stock performance. As of right now, trade negotiations and agreements indicate that tariff levels might not be as high as initially anticipated. Any further confirmation of this could raise stock prices, especially for growth stocks that do well in robust economic climates like NVIDIA. In the upcoming months, NVIDIA's own news may also help the stock. There is cause for optimism regarding revenue statistics in the upcoming quarter, given the robust investment intentions of NVIDIA's clients, ranging from Meta platforms to Alphabet, and the relatively recent debut of the company's Blackwell platform. We should keep an eye on the release of the upcoming chip, the Blackwell Ultra, in the second half, as NVIDIA has committed to an annual cycle of improvements. This is only the beginning and could serve as yet another constructive stimulus. Investors will value proof that NVIDIA can maintain this yearly upgrade rate, which might lead to increases in share price. Lastly, the market for AI as a whole is expanding, with the need for infrastructure expansion still there and the upcoming phases of AI, such the use of AI agents, poised to materialize. The largest seller of AI chips will undoubtedly benefit from this growing scenario, as the AI market is expected to reach trillions of dollars in a few years. All of this indicates that NVIDIA has numerous other growth drivers driving earnings higher at the moment, despite some obstacles, such as a halt in chip sales to China. And this might go on for a very long time. I therefore believe that NVIDIA will rise in the second half of the year, following a first half of UPS and downs. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now let's get back to the video. August 27th, 2025 is when NVIDIA plans to report its second quarter fiscal year 2026 earnings. Prior to the first quarter earnings report, analysts had projected revenue of $46 billion, whereas management projects second quarter FY 2026 revenue of $45 billion, plus or minus 2%. On June 18th, analysts updated their projections to $45.60 billion. Then, on July 2nd, 2025, they lowered them to $45.58 billion, which is within the plus 2% range and equals $45.9 billion. Revenue is expected to increase by 50% annually if it meets its second quarter FY 2026 projection. The management anticipates this strong growth due to the ongoing strong demand for its data center and AI products. Colette Kress, the company's chief financial officer, stated during the first quarter of FY 2026 earnings, "In data center, we expect a drop in revenue from China to partially offset Blackwell's ongoing rise. Please take note that we project a loss of about $8 billion in H2 revenue for the second quarter. The first quarter earnings report's good news is that the switch from the previous generation's Hopper to the upcoming Blackwell B200 GPU graphics processing unit is almost finished. This indicates that the next generation B200 architecture is currently the subject of the majority of the company's new orders and installations. The B200 is often sold by NVIDIA to hyperscalers as a component of a superchip. For example, the GB200 superchip creates a more powerful chip by combining two NVIDIA B200 Tensor Core GPUs with an NVIDIA Grace CPU. In data center, we expect a drop in revenue from China to partially offset Blackwell's ongoing rise. Please take note that we project a loss of about $8 billion in H2 revenue for the second quarter. The first quarter earnings report's good news is that the switch from the previous generation's Hopper to the upcoming Blackwell B200 GPU graphics processing unit is almost finished. This indicates that the next generation B200 architecture is currently the subject of the majority of the company's new orders and installations. The B200 is often sold by NVIDIA to hyperscalers as a component of a superchip. For example, the GB200 superchip creates a more powerful chip by combining two NVIDIA B200 Tensor Core GPUs with an NVIDIA Grace CPU. The main CSP started sampling GB300 systems earlier this month, and we anticipate that production shipments will start later this quarter. With rival high-powered CPUs from Advanced Micro Devices, AMD, following closely behind, analysts keep a careful eye on NVIDIA's product launches. In the current chip competition, AMD seems to be about a generation behind NVIDIA. Therefore, in order to keep a competitive edge, the business needs to stick to the timeline of its product plan. One of the reasons CFO Kress stated key learnings from the GB200 ramp was because the company's gross margins suffered as a result of the GB200 ramp. When ramping GB300, NVIDIA anticipates using the insights acquired from the GB200 ramp to steer clear of the same snag that produced gross margin difficulties during the GB200 Ultra ramp. Vivek Arya, an analyst at Bank of America, adding that NVIDIA's management recently claimed that the switch to Blackwell Ultra should go more smoothly than the switch from Hopper to Blackwell, and that ramp-up expenses should be limited, eliminating any worries regarding gross margins. Gross margins will drop by 3.3 and 3.7% annually if the business meets its second quarter GAAP and non-GAAP gross margin projections of 71.8% and 72%, respectively. CFO Kress stated during the earnings call for the first quarter, "We anticipate a little sequential increase in gross margins due to our Blackwell profitability. Late this year, we're still aiming for gross margins in the middle of the 70% range. Operating expenses will increase by 45% and 43.26%, respectively, if NVIDIA meets its second quarter FY 2026 GAAP and non-GAAP operating expense targets of $5.7 billion and $4 billion. Operating margins should increase in the second quarter since the anticipated 50% growth in revenue is more than the anticipated growth in operating expenses. We continue to expect full-year fiscal year 26 operating expense growth to be in the mid-30% range," CFO Kress stated during the first quarter results call. Following the company's first quarter earnings results, analysts were generally upbeat. On May 31st, Seeking Alpha published an article summarizing the views of a number of analysts regarding the first quarter and the company's outlook for the upcoming quarters. After investors and analysts were impressed by the AI giant's better-than-expected results and outlook, NVIDIA came under scrutiny. Dan Ives, a Wedbush analyst, reaffirmed his outperform rating, calling the quarterly performance robust and the demand commentary very positive, especially when accounting for China. While BofA analyst Vivek Arya increased PT from $160 to $180, Morgan Stanley analyst Joseph Moore maintained his overweight rating and increased PT by $10 to $170. According to Blaine Curtis, an analyst at Jefferies, NVIDIA's second half of the year is looking well, and it is expected to beat or increase from here. You may believe the stock is now overpriced following the company's huge run-up. Let's now examine value. With a trailing 12-month price-to-sales ratio, PS, of 26.1, NVIDIA is above its 5, 7, and 10-year medians, but below its 3-year median. Only the 3- and 5-year data may be applicable now because NVIDIA's revenue generation capabilities have altered significantly over the past 7 and 10 years. The stock's placement between its 3- and 5-year medians may be interpreted by some as an indication that it is trading at fair value. Its stock price would be $165.18, a 3.7% increase over its July 3rd market close of $159.34 if it sold at its 3-year median. Its stock price would drop 6.7% from its closing price on July 3rd to $148.68 if it sold at its 5-year median. NVIDIA's 1-year forward PS to growth PSG ratio of 0.36 is contrasted with that of a number of its competitors in the networking and semiconductor sectors in the accompanying table. This comparative assessment is frequently arbitrary. I still like to do it, though, to see if my subjective assessment and my objective valuation calculations match. NVIDIA's PSG ratio is lower than that of Broadcom and Arista Networks, even though the company has the highest ROIC, the second highest FCF margin, and the quickest expected sales growth. NVIDIA has the highest PSG, which I believe is justified by its ROIC of 101%, which indicates that it is generating the most value for its owners. In this relative valuation, NVIDIA appears to be undervalued. NVIDIA's GAAP TTM PE ratio of 51.39 is below the semiconductor weighted average PE ratio of 53.71, but it is significantly higher than the median for the information technology sector, which is 30.08. Because it is above the median of the information technology sector, which includes businesses that aren't necessarily in NVIDIA's peer group, some people could think it is overpriced. Given that its PE ratio is lower than the weighted average PE ratio for the semiconductor industry, which takes into account businesses that are more closely related to its peer group, some may view NVIDIA as being undervalued. By dividing the company's FY 2026 future PE of 36.64 by analysts' projected earnings per share (EPS) growth of 43.54%, the forward PE to growth (PEG) ratio is 0.84. As a general rule, growth investors believe that stocks with PEG ratios below 1.0 are undervalued by the market. As a result, some would believe that NVIDIA is undervalued by the market. Its stock price would be $186.78, 17.22% higher than its closing price of $159.34 on July 3rd if it sold at a PEG ratio of 1.0. The company may still have upside potential before hitting fair value based on its FY 2026 projected PEG ratio. Additionally, you could legitimately argue that it ought to fetch more than its fair market worth. With a price-to-free cash flow ratio of 53.97, NVIDIA is somewhat over its 10-year median, but much below its 3, 5, and 7-year medians. This could be interpreted as undervaluation by some. The price of the stock would be $218.04, or 36.83% more than its market closing on July 3rd, if it were to sell at its 5-year median. U.S. export restrictions pose the biggest threat to NVIDIA and are already negatively affecting its performance. In her prepared remarks on the first quarter earnings call, CFO Colette Kress stated the following. The U.S. government imposed new export restrictions on H20, our data center GPU made especially for the Chinese market, on April 9th. The former administration gave its consent for us to sell H20. The new export restrictions on H20 did not grant us a grace period to sell through our inventory, despite the fact that our product has been on the market for more than a year and has no market outside of China. We recorded $4.6 billion in H20 revenue in Q1, which came before April 9th, but we also recorded a $4.5 billion charge for purchase obligations and inventory write-downs related to orders we had received before April 9th. The new export restrictions prevented us from shipping $2.5 billion in H20 revenue in the first quarter. Because we were able to reuse some of the materials, the $4.5 billion charge was lower than what we had originally projected. The operating profitability of the business is immediately impacted by the $4.5 billion charge. The money NVIDIA will lose out on in the future, however, is the most worrisome factor. According to the business, the China AI accelerator industry is expected to reach a value of over $50 billion. NVIDIA's access to the Chinese market is now restricted by export rules, which management feels will hurt the business. According to CEO Jensen Huang's remarks, he is adamantly opposed to export restrictions and believes they may eventually make NVIDIA less competitive globally. CEO Huang stated during the earnings call for the first quarter, "Whether or not American chips are used, China's AI advances. To train and implement sophisticated models, it must calculate. China already has AI, so the question is not whether it will have it in the future. Whether one of the biggest AI markets in the world will operate on American platforms is the question. By protecting Chinese chipmakers from American competition, America's standing overseas is weakened. Restrictions on exports have encouraged China's scale and innovation. Chips are only one aspect of the AI race. The question is which stack the world is operating on. American leadership in global infrastructure is at risk when that stack expands to incorporate 6G and quantum. The premise behind U.S. strategy is that China is unable to produce AI chips. That presumption was always dubious, and it is now obviously incorrect. China is an industrial powerhouse. Ultimately, the platform with the most AI developers wins AI. Instead of sending half of the world's AI talent to competitors, export restrictions should bolster American platforms. Without competition, Chinese chipmakers might grow into powerful forces and eventually surpass NVIDIA in terms of innovation. The capacity of American businesses to compete may be hampered if the world ultimately decides to use Chinese technology for its AI stack, and NVIDIA's long-term growth may be lower than some predict. There are other competitors besides Chinese chipmakers that NVIDIA must be concerned about. Additionally, NVIDIA's biggest clients compete with it. An application-specific integrated circuit that Alphabet built in-house is called the Tensor Processing Unit, or TPU. A chip called Inferentia was created by Amazon. The Meta Training and Inference Accelerator is an AI chip being developed by Meta Platforms in response to Microsoft's creation of the Maya ASIC. Some of the aforementioned chips were created in partnership with Broadcom and Marvell. The goal of these companies' in-house semiconductor development is to lessen their dependency on NVIDIA. When it comes to a vital component for their operations, very few businesses like to depend on just one supplier. An ASIC chip's ability to be designed to execute a particular application is another of its most important advantages. This provides it an efficiency edge over NVIDIA's processors that may result in greater cost savings. NVIDIA faces the danger that its revenue growth may suffer if a sizable portion of its clients switch to their own proprietary chips. It must also continue to be mindful of its more established competitors. AMD is chasing after NVIDIA to create a chip that is on par with, or perhaps better than NVIDIA's, despite Intel's recent struggles. Despite AMD's current technological advantage, it cannot afford to take it lightly. From GPUs to networking components, AMD is competing with NVIDIA on every front. With its ROCm, Radeon Open Compute platform, AMD is attempting to breach NVIDIA's CUDA moat. NVIDIA can use GPUs for more than simply graphics processing thanks to CUDA, which also enables it to take advantage of GPU's parallel processing capabilities to speed up a variety of computational tasks. NVIDIA is in a strong position because developers cannot directly use CUDA on AMD GPUs, making it practically difficult for them to use GPUs for AI without CUDA. In order to leverage its GPUs for AI without the need for workarounds, AMD had to develop ROCm. Last but not least, a plethora of businesses with cutting-edge technology and unconventional designs, like RISC-V or photonic chips, have the potential to arise and eventually upend the market. Andes Technologies, Alibaba's T-Head Semiconductor, Cerebras Systems, Grok, Lightmatter, and a startup called Etched are a few instances of businesses with innovative technologies. NVIDIA can face disruption if it doesn't stay up to date with the most recent advancements. Analysts believe that NVIDIA has an 80% to 92% market share in data centers for GPUs, despite the competition. Without a doubt, the company is presently the market leader in AI infrastructure, which may be worth trillions of dollars if Jensen Huang's goal of having AI in every significant sector is realized. The company's TTM sales as of the first quarter of FY 2025 was $148.51 billion, demonstrating its leadership in providing networking equipment and AI accelerators to the data center infrastructure sector. NVIDIA has only seized 7.4% of an estimated $2 trillion potential, despite these remarkable figures. Some analysts have predicted that NVIDIA will attain a $5 trillion market capitalization over the next few years due to its ongoing dominance and still enormous potential growth runway. We still think that NVIDIA will reach a $4 trillion market valuation and eventually a $5 trillion one in the upcoming years as the fourth industrial revolution unfolds, driven by AI powered by a single chip worldwide. NVIDIA, noted Wedbush analyst Dan Ives in a recent statement, NVIDIA's FY 2026 forward PEG ratio and P/FCF metrics are at an alluring level for a firm of this caliber, despite the fact that value investors may find the stock's valuation excessively high in other areas. Growth investors ought to think about buying stock. I continue to have a high NVIDIA buy rating. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.